Okay, hello everyone. It has just gone 12 o'clock, so let us start the session. I have started the recording for the benefit of those students who are not able to attend live. My name is Dr. Storm Kennedy Palmer, and I am a lecturer on ECS 2602, Macroeconomics. Today, we're going to be looking at Learning Unit 5, which is openness in the goods and financial markets. Up until now, we've considered the determination of output and income for a closed economy, but we're going to introduce the foreign sector today to lay the foundation for Learning Unit 6, where we're going to determine the output and income level for an open economy. Once you've worked through this learning unit, you should be able to describe openness in the goods and financial markets, define the nominal exchange rate, define the real exchange rate, describe the components of the South African balance of payments, describe the interest parity condition, and use the interest parity condition to choose between domestic and foreign bonds. We first need to clarify what we mean by openness in this module. From an economic point of view, a country's openness to other countries can be separated by the goods, financial, and factor markets. Openness in the goods market refers to the ability of consumers and firms to choose between domestic and foreign goods. Thus, it refers to how freely goods and services can be traded across borders. Tariffs are taxes on imported goods. We've heard a lot in the news recently about Trump and his plans to increase tariffs. So that's essentially a tax on imported goods that will in effect be paid by Americans, making imported goods more expensive, and good luck for the American economy. And quotas are restrictions on the quantity of goods that can be imported. So the tariff is an actual tax which increases the unit price of an imported item, and a quota is a restriction on the quantity that can be imported. No country is completely free from restrictions like tariffs and quotas, but a country with high openness in the goods market has low tariffs and few import restrictions with minimal trade barriers. So an example of this would be the European Union, which has a highly open goods market due to free trade agreements among the member states. And likewise, no country is completely closed, but North Korea, for example, has a very low openness to the rest of the world. So North Korea is an example of a country with very low openness to the rest of the world. Then in the financial market, openness refers to the ability of financial investors to not only choose between money and domestic financial assets, but also to include foreign financial assets in their portfolio and to speculate on the movements in foreign interest rates versus domestic interest rates and movements in exchange rates, etc. A country with high openness allows foreign investors to buy domestic assets and domestic investors to buy foreign assets with few restrictions. A country with low openness imposes capital controls, currency restrictions, or limits on foreign investment. Openness in the factor market refers to the ability of firms to choose where to locate production of workers and to choose where workers want to work. So a country with low openness in the factors market may restrict immigration and foreign direct investment. Since it plays much smaller role in the short and medium run, which is what we look at in this module, we will ignore the factors market and focus instead on the implications of openness in the goods and the financial market. Do we have any questions so far? Sorry, yes, continue.
I'm just saying we're good.
Okay, great. Thank you. Okay, so now let's look at a very, very, very simple example here. When buying goods, people, which can be households, businesses, and the government, can choose between domestic and foreign products. This choice is influenced by the real exchange rate, which depends on the nominal exchange rate, the domestic price level, and the foreign price level. Okay, so say, for example, you go to the shops to buy chocolate. You like the South African-made bar one exactly the same as the British-made Mars bar. Which one do you buy? So if your preferences are identical and they weigh the same, then you would choose the cheaper option rationally. The cost of the bar one depends on the domestic price level, i.e. the local costs of its ingredients like the milk, the sugar, the labor, and the other inputs for the final product. And then likewise, the cost of the Mars bar depends on the foreign price level. Therefore, an increase in the domestic price level will increase the cost of the bar one, and the increase of the foreign price level will increase the cost of the Mars bar. So if we were to look at this very simply and unrealistically, we could say that the bar one is sold for R1, and wouldn't that be nice? And the Mars bar is sold for £1. How do you compare them? You use the nominal exchange rate. Now, in reality, chocolate isn't that cheap, and the price of the Mars bar will be quoted in rands in your local shop, so you don't need to do these calculations yourself. But we will use this simple example to illustrate how an appreciation or a depreciation of the local currency is going to impact the price of imports. So assume the nominal exchange rate is R1 equals £1. What is the price of the Mars bar in rands? Well, it's simply going to be R1. In this case, they are perfect substitutes. But what happens if the domestic exchange rate depreciates, i.e. R1 buys you less British pounds than before? Well, let's do it as an activity together. So assume the South African rand depreciates. As a chain of events, we represented it in this module as E with a decreasing arrow from R1 equals £1 to R1 equals 90 British cents. What is the price in rands of a £1 Mars bar? Would anyone like to take a guess? Not seeing anything in the chat, so let me
guess it's R1.11.
Perfect. Okay, great. I'm very glad to hear that you were able to calculate that on your own. Now, for the rest of the people, can you see my calculator there? Even just a thumbs up is fine. Okay. All right. So yes, you correctly identified that it's going to be C, which is R1.11. So how did we get there? We now know that the currency depreciated from R1 equals £1 to R1 equals 90 British cents. So in order to calculate the cost in rands, we'll take 1 divided by 0.9 is equal to 1.11 recurring, and since it's 1, we don't round up, so it's just R1.11 in this case. Okay, so if you go to the shop, the bar one is going to cost you R1, and the Mars bar is going to cost you R1.11. They are now no longer perfect substitutes because of the depreciation of the rand. So assuming that the domestic and the foreign price levels didn't change, it was only the exchange rate that changed, it's now cheaper to buy the bar one, and sales of the bar one will go up, which is good for the South African company that produces it. But now this is not always the case, because not all imported goods have near perfect substitutes in the domestically produced goods. In those cases, consumers will have to pay more for the imported product because there isn't a suitable alternative. Now let's see what happens if there's an appreciation of the domestic currency, i.e. the rand can now buy more British pounds. Okay, would anyone like to hazard a guess? I'm not hearing anyone. Maybe you were mic'd there, muted. Okay, so if the South African rand appreciates, what is the price in rands of the Mars bar? So it's going to equal simply 90 cents, because this is the new exchange rate. So if we consider that example, you go to the shops, the Mars bar is 90 South African cents, and the bar one is R1. They're no longer perfect substitutes. The Mars bar now costs less. And assuming that there was no change in the domestic and the foreign price levels, it's now cheaper to buy the Mars bar. The sale of the Mars bar will go up, and it's good for the British company that's producing it. So now I'm sure you'll see that the exchange rate quotation we use in this module is not the same as the one that we commonly see in the news. This is because we use the indirect method instead of the direct method of quotation. So let's go through that. Using the indirect method, we express the price of the foreign currency in terms of the domestic currency. In other words, at the time the data was collected, 1 rand was equal to 0.042935 British pounds. And you can see that the rand is much weaker against the British pound than our simple example of 1 rand is equal to 90 British cents or 1 British pound. So this is the rate that you most commonly see in the news. 1 rand is equal to, or 23 rand is equal to 1 British pound. In this module, we need to get used to using the indirect method. If you would like to answer a question or ask me a question, please do unmute yourself. But yeah, if you're just watching the presentation, I think rather keep yourself on mute so that it's not creating any background noise there. So I hope the difference between the indirect method and the direct method is clear to you now. And although intuitively, because of the news, we think about things in terms of the direct method, for the purposes of this module, we need to get used to thinking in terms of the indirect method. So assume that the exchange rate is 1 rand is equal to 0.042935 British pounds. What is the price in South African rands of a 1 pound Mars bar? Would anyone like to try and answer that?
Option C.
Ah, yes. Did you say option C?
The option C, yes.
Yes, perfect. That's right. It was on the previous slide, but that is 100% correct. So thank you for that. I see we've also got Lerato in the chat, correct as option C. Okay, so you can see now this is a much more realistic price for a bar of chocolate these days. And again, going back to the previous slide, we see that this is simply the inverse. These two are the inverse of each other. We see that a change in the nominal exchange rate impacts the price of imports, but up until now, we've ignored the impact of changing domestic and foreign prices. So let's look at that as we move from nominal exchange rates to the real exchange rates. So up until now, we've been looking at a very simplified chocolate example. That's actually a microeconomic example because it looks at a specific product, specific industry. This module, we're dealing with macroeconomics, where we look at the economy as a whole. So we're not looking at the prices of individual products, but rather the general price level, okay? So there could be a situation where, excluding changes in the exchange rate, where for some reason the price of cocoa in South Africa increases exponentially for whatever reason. Perhaps there was a bad crop or we couldn't import a substitute or something happened, okay? That means that chocolates that were produced in South Africa during that time would become much more expensive because cocoa is a very necessary ingredient in the making of chocolate. But if we were to assume that at the same time in Britain, their cocoa prices remained unchanged, it means that the chocolates that they produce there and they import or export to South Africa wouldn't change prices. So then the South African chocolates would be more expensive than the British chocolates just because of the ingredients, the change in the price of the ingredients necessary to make it, okay? So that's a microeconomic example. In macroeconomics, we're looking at the general price level, and another word for a change in the general price level is known as inflation. So that's where we're not looking at specific prices, we're looking at prices overall in the whole country. So maybe prices overall increased by 4%, for example. Okay, I hope we're clear on the difference between the general price level and specific prices, and that in this module, we're looking at general prices. I simply use the chocolate analogy to introduce you to the concept. Okay, so inflation is defined as the sustained rise in the general level of prices. In our first 4 learning units, we assume that the price level is fixed. Now we're going to see how a change in the general price level impacts the real exchange rate, because remember, the real exchange rate is a function of the nominal exchange rate, the quoted exchange rates that you see in the news, and the change in domestic and foreign price levels. So how do we measure a change in the general level of prices for 2 different economies? Well, the easy way to do it is to use the GDP deflator. It's calculated as nominal GDP divided by real GDP expressed as a percentage. And expressing it as a percentage is what allows you to compare it between different countries. So a GDP deflator of 100 indicates no change in the general price level. 1 above 100 indicates that there is inflation or increasing prices, and 1 below 100 indicates deflation or falling prices. So let's look at this example. We need to calculate the real exchange rate given the following information. So we're told that the GDP deflator for South Africa is 110. We're told that the GDP deflator for the USA is also 110. And we're told that the nominal exchange rate is 1 rand is equal to 10 American cents. It's not. Okay, does anyone want to hazard a guess before I continue? Okay, so we need to...
Sorry?
Sorry, go for it.
I think the equal, since the 2 deflators for South Africa and USA are equal.
Mm-hmm.
So the answer is 1 rand is to 10 cents. 10 cents of a dollar.
Yeah. So you're quite right that the GDP deflators, because they're the same, they sort of cancel each other out, which means that in this particular example, the difference in prices in the foreign country and the domestic country are not relevant because they are the same. In both countries, inflation is rising by 10%. Okay, so you can sort of exclude the role of the change in prices, and you just look at the nominal exchange rate, which means that 1 rand is equal to 10 American cents. Okay, perfect. But
sorry, can I disturb? Sorry, Miss Kennedy. I just want to ask something. In order for us to calculate this, is there any formulas or that work on?
Yeah.
Can you please assist me with that, because I'm a bit lost, eh?
Yes. Yeah, we'll definitely go to that now. Okay, so I just wanted to sort of introduce you to the intuition of it, that when we're looking at the real exchange rate, a part of it is determined by the domestic price level and the foreign price level, and a part of it is determined by the nominal exchange rate. So leaving it as the same for now is easy, because then they just cancel each other out. But you're quite right in that if we have a more complicated scenario, the only way to calculate it would be to use a formula. Okay, so let's look at the formula for the real exchange rate. It is this over here. So you've got this cursive E, which is equal to the nominal exchange rate represented in the indirect method, not the direct method, the indirect method, times the domestic price level, okay? And that is over the foreign price level. The foreign price level is indicated by the P with the asterisk. Okay, so in our case, this is the South African price level up here. The foreign price level is P with an asterisk, and the nominal exchange rate is the capital E. Okay, so as I said to you, in this example is very easy because the two price levels just cancel each other out, which equals 1. So 1 times 0.1 is 0.1, which gives us the answer, which is the same as the nominal exchange rate. So in this case, the real exchange rate is equal to the nominal exchange rate because these two cancel each other out. So the correct option, as indicated earlier, is B. So now we're given different figures for year 2, and we're asked to calculate the real exchange rate. So the nominal exchange rate has remained unchanged, but the GDP deflator in South Africa is higher, meaning that prices have been rising at a quicker rate in South Africa than they have in, well, actually, for year 1, it was 110 for the USA. So for some reason, they had no inflation that year. So in order to calculate that, we just pop it into our formula, and you see that our nominal exchange rate now is 0.11 American cents per 1 rand. So the real exchange rate is higher than it was, despite the nominal exchange rate remaining unchanged, because there was a higher increase in prices in South Africa. Does that make sense how the two elements come in, the domestic and foreign price level, as well as the nominal exchange rate? Okay, I see a thumbs up there. Please stop me if you are unsure. This is the same example. Yes, okay, so the correct option is C in this case. So now we're asked to indicate what happened to the real exchange rate. We already calculated that it went from 1 rand equals 10 US cents in year 1, and it increased to 1 rand is equal to 11 US cents in year 2. So therefore, would you say it has appreciated or depreciated, or it's impossible to calculate?
Appreciated.
Perfect. Yes, it's appreciated, which is option B. So a significant implication of this is that a depreciation of the currency is not necessarily sufficient to cause a decrease in the real exchange rate. If the depreciation is accompanied by an increase in the domestic price level, then the rise in the domestic price level compared to the foreign price level erodes the impact of the depreciation. Okay, so to summarize, an increase in the relative prices of South African goods compared to foreign goods will lead to a real appreciation, whereas a decrease in the relative prices of South African goods compared to foreign goods reduces the exchange rate, i.e. a real depreciation. Is everyone good with that?
Ma'am, can I stop you there?
Yes.
Can you go back when you said where inflation and impacts nominal depreciation or something?
It was at the previous slide I said that.
Something was wrong with my laptop.
Oh, okay. Okay, so was it where I was talking here
about depreciation and appreciation and how much it can impact the normal exchange rate?
Okay, yeah. So what I was basically trying to say there is that the real exchange rate is impacted by two factors. You've got the price level of the foreign and the domestic price level, and you've got the nominal exchange rate. So even if there's a depreciation of the domestic currency, it can be overwhelmed by the impact of an increase in the domestic price level, okay? So it's not guaranteed that just because our nominal exchange rate depreciates, that there's going to be a depreciation in the real exchange rate, because the change in prices might overcome that change.
Are you, when you're saying real exchange rate, are you talking about goods and services, domestic goods and services, as to foreign goods and services?
Okay, so it's not relevant in this particular example. So if, for example, this exchange rate changed, okay, so if this exchange rate in year 2 was changing, but because of the increase in prices, it wouldn't be fully felt as a depreciation of the real exchange rate. So I see what your issue is because the nominal exchange rate didn't change in this example. So you're just wondering why I'm saying that there can be two forces in play. I'm not really referring to this example. I'm just I'm saying that is an implication that a change in the nominal exchange rate can be completely overcome if there's a significant enough change in the price level.
If it goes up.
Yeah.
Oh, okay. I get it now. Thank you.
Okay. Thanks for that. Yeah, that was a little bit confusing because the example doesn't have the nominal exchange rate changing. So thank you for spotting that. Okay, so we've looked at openness in the goods market. Now we're going to look at openness in the financial market. Okay, so openness in the financial market refers to the ability of financial investors to not only choose between money and domestic financial assets, but also to include foreign financial assets in their portfolio and to speculate on movements in foreign interest rates versus domestic interest rates, as well as movements in the nominal exchange rates. A country's balance of payments records all economic transactions between the residents of the country and the rest of the world over a given period. It accounts or consists of the current account, which tracks trade in goods and services, income from abroad, and transfers. And then you've got the capital and financial account, which records the capital flows, the foreign investments, and the financial transactions. So you can think of the first part, the goods that we were looking at, as being tracked in the current account. Now we're looking at the capital and financial account, which records the capital flows, foreign investments, and financial transactions. And then lastly, you've got the official reserves, which shows changes in a country's foreign currency and gold reserves to balance the balance of payments. So openness in the financial market allows a country to have a trade deficit or a trade surplus because it enables the free flow of capital across borders to balance those. When a country runs a trade deficit, in that case, imports exceed exports, it can finance the deficit by attracting foreign investment or from borrowing from abroad to run a capital account surplus. Conversely, a trade surplus, where exports exceed imports, allows the country to invest its excess savings in foreign assets. This flexibility in capital movements helps balance international trade without immediate economic constraints. Okay, activity. Will the following event result in an increase or a decrease in foreign reserves? An increase in exports. What would you say? Does it increase or decrease foreign reserves?
Increase.
Mm-hmm. Yes, because it's going to bring in foreign currency because we are selling our products made in South Africa to the rest of the world, and we're receiving foreign currency as payment for those goods or services that we produced in our country. So exports bring in foreign currency, and an increase is going to increase foreign reserves. Similar question, will an increase in imports increase or decrease foreign reserves? What would you say?
To decrease.
Decrease, yeah, exactly. Because imports we're bringing into the country, and our South African rands are having to leave to go to pay for these goods that we've imported. So it's going to lead to a decrease in our foreign reserves. Will the following event result in an increase or a decrease in foreign reserves? An increase in capital inflows? What would you say? Okay, I've got Latabo in the chat saying increase. That's right. So yeah, a capital inflow, bringing foreign investment or loans for that matter, is going to increase the reserves that we have in our country. Opposite way around, I think everyone can agree it's going to be decrease, And this could either be due to less foreign investment, or we have to pay back the loans that we took out, but it's going to result in a decrease in our foreign reserves. Will an increase in the deficit, so an increase in the deficit on the current account, will it increase or decrease foreign reserves?
It will decrease.
Yeah, it's a little bit of a double negative of a question, an increase in the deficit. So current account is looking at our trades of goods and services, and a deficit means that our imports are exceeding exports. So if that then increases, it means we have even less foreign reserves, so a decrease in foreign reserves. A decrease in the surplus on the financial account, would that lead to an increase or decrease in foreign reserves?
Decrease.
Yeah, it's going to be a decrease, because the financial account is where we record our financial flows. I'm just gonna.
What's your problem?
Hold on, I'm just gonna mute quickly. Yes, so the financial account is where we record the flows of financial investment to and from the country. And if there's a surplus, that means that there's more investment being received into the country than is going out. But if that's decreasing, then it means that our foreign reserves are decreasing. So the choice between domestic and foreign assets. Higher domestic interest rates is equal to higher investments in domestic assets, and the expected domestic currency depreciation will lead to higher investment in foreign assets. So when investors are considering the choice between domestic and foreign assets, they would consider both the interest rate and the exchange rate movements when deciding between domestic and foreign financial assets. Higher interest rates attract investments, while exchange rate expectations can either enhance or diminish returns. If the domestic currency is expected to have depreciated at the time of the maturity of the asset, then the return on the foreign assets increases. Why? Because if I, as a South African citizen, want to invest in UK bonds, I need to convert my rands into pounds at the initiation of the investment, day one of the investment, to buy the UK bonds, which are priced in pounds. Then at the maturity date, I need to convert those pounds back into rands, send them back to South Africa. And if there was a depreciation of the rand, and my pounds are now worth more in terms of rands, then my return from holding the UK bonds is higher than the interest rate would indicate. So that's why we need to consider exchange rate expectations. And it's expectations because we're not considering the exchange rate at the date that we make the investment. We want to consider the expected exchange rate at the time that we're going to bring our money home. Whether we take a 1-year UK bond, then we need to consider the exchange rate in 1 year's time. If we take out a 20-year UK bond, then we need to take into account expectations for the exchange rate in 20 years' time. So smart investors balance these two factors to optimize their portfolios while managing risk. Okay, so obviously we haven't discussed any sort of risk in this module, and that's because we're not giving you investment advice, just because it looks as though expected exchange rates are going to do one thing doesn't mean it's going to do that. Some global financial crisis could happen, and then suddenly the rand depreciates more than it was expected to. Or, I don't know, we join the BRICS currency and suddenly our currency is worth more than it was before. There's a whole range of risks when investing domestically, and those risks only increase when you consider investing abroad as well. So again, not providing financial advice, just saying that if you're considering the choice between domestic and foreign assets, you've got to take into account interest rates as well as the expected currency movements at the time that you want to bring your money back. Okay, so let's look at an example. Suppose you're a South African with 100,000 Rand to invest. You're trying to decide whether to invest in South African bonds or American bonds for 1 year. So you're given the following information. The interest rate on a 1-year South African bond is 4%. The interest rate on a 1-year USA bond is 3.8%. So if you exclude the exchange rate, it looks as though it is more profitable to invest in South African bonds. But we must factor in the exchange rate or expected changes in the exchange rate. So we're told that the current exchange rate is 1 Rand to 10 US cents, and that is expected in 1 year's time, when the bond is going to mature, that the currency is going to be 1 Rand to 0.11 US cents. Okay. In other words, the Rand has appreciated. It's buying more US dollars than before. So in order to decide which bonds to invest in, you need to calculate the expected return on each of the bonds for the period, which is a year in this case. And of course, again, the caveat is that we're ignoring all risks and the transaction fees, because usually it's more expensive to invest abroad than it is to invest with your local bank or financial intermediary. So it's easy to calculate the expected return on the South African bonds since you have rands to invest, and you can ignore the exchange rate component and only look at the interest rate on South African bonds. And again, it's 4%. So 4% of 100,000. This is the formula that you're going to use, where the return on South African bond held for 1 year in South African Rand is R times 1 plus IT, where R is the amount of rands to be invested, in this case 100,000 rands. IT is the domestic interest rate, 4%. So if we input those values, we can see that 4,000 Rand is your interest, and at the end of the term, you'll get your initial amount back plus your interest of 4%. So you'll get 104,000 Rand. But now let's look at what happens if you're going to buy a USA bond. And just to return to that question, the answer was B. So the expected return on the South African bonds is 104 Rand. It's not going to be dollars, and it's not this because we use the South African interest rate of 4%, not the USA interest rate of 3.8. So now, if we want to consider investing in the USA bonds, we need to take the exchange rate into consideration. So our formula, understandably, gets more complicated. So now it's going to equal RET times 1 plus IT, asterisk indicating foreign, close bracket, open bracket, 1 over expected exchange rate at time t plus 1. And time t, this plus 1 is whatever your term is. So in our example, it's simply 1 year. The existing time, which is today, plus 1 year. It could be any maturity, as I said earlier. So R is the amount of rands to be invested. ET is the nominal exchange rate. The foreign interest rate, which is 3.8, the interest rate for the USA bonds that we were given, 3.8, and then 1 over the expected nominal exchange rate. So if we input all of our given information into that formula, we'll see that we get 363 Rand 64 cents at the end of the day. So we've actually lost money by investing in USA bonds. So which bonds should you invest in? I think it's very clear that we would, in this case, invest in South African bonds.
I'm so sorry to interrupt.
Yes.
Could you please go back to the previous slide? I'm taking notes and I got a bit behind. Just for 5 seconds, please.
Sure.
Thank you. Thanks a lot.
I will also share these slides for you all on the module site, so you'd be able to download them there and refer back to them if you need to.
Thank you. Just the slide before this one, please.
Oh, sorry. There we go.
Thank you very much.
Yeah, so does anyone have any questions? We have a little over 10 minutes left, and this was the last example I wanted us to go through. So are there any questions you'd like me to answer for the rest of the time? Not seeing anything in the chat. You can just go ahead and unmute yourself if you have a question. Okay, are you done with this slide? Can I move on to the last one?
Yes, thank you. I'm done. Thank you.
Okay, great. The interest parity condition states that financial investors will seek the highest expected return, and through arbitrage, the returns on investments in different countries will equalize. So how does it work? If one country, for example, South Africa, offers a higher interest rate than another, for example, the USA, investors are going to move their money to South Africa. So there's going to be a capital inflow, which increases the demand for South African assets, raising their price and then lowering their return eventually. And at the same time, the exchange rate adjusts, affecting returns from foreign investments. This process continues until the expected return on investments in both countries equalize when adjusted for exchange movements. So if South Africa offers 5% on bonds, while the USA offers 2%, then if the Rand depreciates by more than 3%, US bonds become more attractive despite their lower interest rate. And if the Rand depreciates by less than 3%, or it happens to appreciate, South African bonds will be the better option. And if the Rand depreciates by exactly 3%, then investors will be indifferent between the two. And remember, when I say indifferent, I'm not taking into account transaction fees and the difficulty of investing abroad and potential restrictions on financial investments abroad that might exist. So the key point is that when choosing between domestic and foreign investments, you need to consider both the interest rate differences and the expected exchange rate changes to determine which is going to offer the better return. Okay, I've got a question in the chat. Do the formulas change when calculating the returns on bonds, since the South African one and the US one are not the same? Yes, there are different formulas. So the South African, I wouldn't actually put it as South African and USA. I'd say as domestic versus foreign. So if we were Americans, then we would use the simpler formula to calculate investment in US bonds, because we would be using US dollars to make our investment. And in that same scenario, we would use the more complicated formula to establish what our return would be if we were to take our US dollars and invest in the South African bonds. So this is the calculation for foreign bonds, and this is the calculation for domestic bonds. Now, in essence, you could just remember this one, because you're going to take out inflation, the exchange rates, and instead of using the foreign interest rate, you're going to use the South African interest rate. So you see, if I do that, we've got the initial formula, which is that our rands to be invested of 100,000, we times that by 1 plus the interest rate, which was 4% for South African bonds, and 1 divided by nothing, or 1 divided by 1 is 1, and this amount times 1 is 1. So essentially we could just get rid of that. Anything times 1 is itself. And doesn't that look familiar? That's the first formula that we used. So I just put it by itself in the first calculation so that you could get the intuition of what you're looking for. But in actual fact, you can use this formula. It's just that these items will not be relevant because you're not looking at a change in the exchange rate, because you're taking South African rand, you're investing it in a South African financial product. Your return is going to be in South African rands. At no point do you need the exchange rate, because you're not going to convert your rands into a foreign currency at any point. You invest in rands and your investment returns are in rands. So I hope that makes sense. Okay, great. Thank you for that response in the chat. I'm glad that that's clearer. All right, do we have any more questions? We have 5 minutes left in the session. Okay, I'm not seeing anything in the chat. I'm not seeing any hands either. The next session that I will be doing is Learning Unit 9 for this module, which I'll be doing on the 7th of May, part 1. It's quite a big learning unit, so we'll split it into 2. So I'll do part 1 on Wednesday, the 7th of May, and then part 2 on Monday, the 12th of May. So that is the next time I will be seeing you. Is there anything anyone wants to ask just before we end the session?
Yes, please, Dr. Kennedy. I don't know if it's too early to ask this, but are the exam dates available yet?
No, I haven't seen anything yet. It should be in May, June is our exam period, but unfortunately I haven't seen any exam dates released just yet. Okay, is there anything else? Okay, I see a lot of thumbs up. So on that note, I think let's adjourn. Thank you very much for joining me for this session. Wait, hang on. Selo, I saw a hand there, but I think maybe you tried to do something else. Yeah, I think maybe you tried to use an emoji and the hand popped up. Okay, in the chats he's just indicated that it was a mistaken hand. All right, well, thank you, everyone. Thank you for joining the session, and we will make the recording available online so you can listen to it again if you want to, as well as the slides will be made available on the MyUNISA site for this module, so you'll be able to access them then. All right, thank you, everyone, and I will see you at the session for Learning Unit 9, Part 1 in May. I hope you have a good afternoon. Goodbye.
Thank you. Goodbye.